Hi friends, welcome to FinMac Business Solutions. Today we are going to discuss important sections of Partnership Act 1932. Indian Partnership Act 1932 is a central act passed by Parliament. This act deals with a special type of contract of partnership. This act extends to the whole of India except the state of Jammu and Kashmir. This act came into force on 1st October 1932 except section 69 which came into force on 1st day of October 1933. Meaning and definition of partnership. Section 4 of the Partnership Act 1932 defines the term partnership as under. Partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Section 4 of Indian Partnership Act 1932 provides that persons who have agreed into partnership with one another are called individually partners and collectively firm, and the name under which their business is carried on is called firm name. A firm is not a separate legal entity distinct from its members. It is merely a collective name of individuals composing it. Section 464 Companies Act provides that the maximum number of persons a firm can have, according to Section 464 of the Companies Act 2013, number of members shall not exceed 100. But Rule 10 of Companies Rules 2014 says it is 50. Hence, the maximum number is 50. If the number of partners exceeds the aforesaid limit, the partnership firm becomes an illegal association. If an association of persons or a firm having members or partners exceeding the above limit will not be an illegal association if the firm's objective is not to earn profit. Essential elements of partnership. Two or more persons is required. There must be a contract. That contract is to share the profit of business, and there must be mutual agency. Mutual agency is the conclusive proof. Nature of partnership. A partnership is not a person in the eye of law except for the purpose of taxation. Section 231. If it has no separate legal entity like a company apart from partners constituting it. Further, Section 5 of the Act provides that partnership arises from contract and not from status like HEF. Take an example. There are two firms, namely PQR and ABC. These two firms are contemplating to form a new firm. Can they do so? Answer is no. Since firm has no separate legal entity, it cannot form another firm. Real test of partnership. The true test of partnership is the existence of mutual agency relationship, that is the capacity of a partner to bind other partners by his act done in firm's name and be bound by the acts of other partners. Sharing of profit is an essential element of partnership, but it is not a conclusive proof of partnership. Sharing of profit is prima facie evidence. Thus, partnership can be presumed when there is an agreement to share the profits of business and the business is carried on by all or by any of them acting for all. The relation among partners can be ascertained as under. If there is an express contract, the real relation is ascertained from the partnership contract. If there is no express contract, the real relation is ascertained from all the relevant factors such as contract of parties, books of accounts, statement of employees, etc. Meaning of mutual agency. Mutual agency refers to the relationship of principal and agent among partners. Example, in case of a firm having partners A, B, C, when A acts, A is an agent, B and C principal. When B acts, B is an agent and C are principal. When C acts, C is an agent and B are principal. Partnership does not exist though there is profit sharing. In the following cases, there is profit sharing but partnership does not exist just because of lack of mutual agency. Joint owners of some property sharing profit or gross return arising from property. Example, X and Y jointly purchases a building and contributed capital equally to convert the building into hotel. They let it out on a rent of rupees 10 lakhs per annum and share the rental income equally. It's not considered as a partnership firm. Few more examples. A lender of a firm who receives a share of profit. A widow or child of a deceased partner who receives a share of profit. A servant or an agent who receives share of profit as part of his remuneration. A person who receives a share of profit in consideration of sale of business or goodwill of the business. Member of a Hindu undivided family carrying on family business. Burmese Buddhist husband and wife carrying on business. Let us see the characteristics of partnership. Partnership firm has the following characteristics. 2 or more members. There should be at least 2 members. Unlimited liability. The liability of partnership is unlimited. Voluntary registration. Registration is not compulsory. No separate legal existence like companies. Restriction on transfer of interest. Transfer of shares should be with the consent of other partners based on agreement. Partnership is based on agreement among the partners. Partners are competent to contracts. Only competent person can enter into a partnership contract. Partnership may be only for lawful consideration. Lawful business. Partnership should have a lawful object. It cannot form for any legal object. Let us see the difference between company and partnership firm. Regulation. We all know companies are regulated by Companies Act 2013, but partnership is regulated by Partnership Act 1932. Number of members. Maximum number of members of a private company is 200 currently. No limits in case of public limited company. Partnership Act does not limit the number of members, but Companies Act restrict. According to section 4 rule 10 of rules 2014, it is 50. No separate legal entity in case of partnership firm. There is a separate legal entity in case of company. Liability of company is limited. That of partnership firm is unlimited. Authority of members. Shareholders has no legal right to bind members as in the case of firm. Each partner has implied authority to bind co-partners by act done in normal course of business. Management. Management vests with the board. All the partners are entitled to take part. Transfer of interest. Share of public limited companies are freely transferable. Partners cannot transfer without the consent of other partners. Audit. Audit of accounts of companies compulsory. No such requirement under Partnership Act, but audit requirement is specified under Income Tax Act, VAT Act, etc. Now the GST also came into force. Registration. Company registration is essential. No such compulsion in case of partnership firm. Winding up. Winding up involves legal formalities. Partnership at will can wound up with much formalities. Now, rest of the section we will see in the coming videos. Please watch second part also. Thank you for watching.